Welcome, everyone. Today, we're going to be hosting a webinar to cover de-risking the MGA model. There's been a lot of excitement recently about MGAs becoming a full stack carrier and the growth potential of the market. In fact, it's an area that we've done a fair amount of research ourselves. We just more or less completed or in the final stages of a study we did on 48 MGAs to learn more about their business models. And based off of some of that research, we were able to find out that almost 20% of the MGAs have taken the step to take more of their stack and take more control. But ultimately, understanding where the biggest risks of MGAs are is not a simple process, and a lot of it comes down to your line of business and your configuration. So we decided to invite an expert to join our conversation. So Gabe Weiss, who's one of the co-founders of XN Captive, is joining us today and will be leading a discussion on de-risking the MGA model, helping you understand where the critical failure points in the MGA and how you can take control of that and address things. Gabe's also going to be part of our spring conference. So those of you who are not familiar, but we run a conference every year, usually end of March, early April. 2025, our spring conference is going to be on April 2nd and 3rd. So this webinar will hopefully get you ready to some of the discussions and meetings at that conference. And, for you guys joining today, we're going to be giving you all, after the webinar sometime tomorrow, a discount on the spring conference. So I'd like to introduce Gabe Weiss. He is a serial entrepreneur. He founded a little startup that happened to solve subrogation problems. He also dates his career all the way back to being part of our national service and has defended our country. So has a wide range of skills and knowledge from claims to the real world. And he's going to be talking to you about de-risking the MGA model. So Gabe, I will pass it to you. And I think for those in the audience, if you do have questions, there's a Q&A button at the bottom of your screen. Please submit the questions as we go along. I think Gabe's able to answer some of them during the presentation, but many of them he'll answer towards the end. And I'll hand it off.
David, thank you for that very, very kind intro. I'll be joined by my colleague, Judah. I presume that folks can see and hear us, but if you can't, I'm sure somebody will let us know there are technical issues and we can address that. So no need to kind of go over my background after David's kind intro. XN Captive is a captive management firm. So that means we form and manage captives on behalf of clients. Our clients extend to many MGAs, and we're going to spend some time talking about what all of that means. I'll ask my colleague Judah to quickly introduce himself, and then we'll get right into it.
Thank you, Gabe. Appreciate it. I'm a pleasure to be here today. I started my career in the finance world, in corporate finance and investment banking, and made my way over to the insurance side of things through a family office. I started a commercial agency together with the family office, where we brokered policies for large commercial real estate schedules and skilled nursing and senior care, and ended up moving in-house where we had a workers' compensation carrier, a risk retention group that was operating in 50 states, and a few offshore vehicles out in Bermuda that we were utilizing to reinsure and write some programs out of. Overall, overseeing roughly $200 million in assets across our different carriers. We were writing about $100 million a year in insurance across the different operations, and oversaw that portfolio of operating assets. Joined XN Captive in January of 24 with the thesis and the understanding of alternative risk and captive insurance being a game changer both in the self-insured space and the MGA space.
So today we're going to talk about the lay of the land for MGAs. today and the particular nuances around taking risk, capacity, and distribution, and why that, and given some macro trends, is lending itself to so many MGAs looking at and ultimately deciding to form or participate with a captive or some kind of risk-bearing entity. We'll look at what that actually means, different benefits and considerations, some of the pitfalls, some of the complexities to address, the processes and what's involved in taking this from an idea to executing upon it. And then we do want to leave quite a bit of time at the end for questions and answers. We know some folks here probably have very particular things they're trying to work through or understand. So rather than us kind of prognosticate in a vacuum, we want to address points that are really topical for you all. To that point, as it says at the bottom, please do drop questions at any point in the Zoom chat, and those will make their way to us, and we can address those either throughout the presentation or at the end. All right, let's go from there. So MGA dynamics, I think given the audience today, you know, and the topic and why people have decided to join us for this webinar during your lunch break or during your busy day, I imagine this is pretty old hat for everyone here, MGA dynamics, and really how MGAs accelerate as a distribution model. And they can do that in a pretty light way without having to invest considerable assets up front. So then when you contemplate the MGA model today and the distribution mechanics and often bringing novel data and technology solutions to bear, MGAs kind of live and die by their ability to attract and retain capacity at favorable terms from markets, from either primary carriers, fronts, or reinsurers. And, you know, this kind of boils down to a number of explicit challenges. Getting an MGA up and running is about putting in place the right pieces around distribution, technology, mechanics, but ultimately it's about finding the right capacity and kind of the cumbersome process that goes with that. I imagine a lot of people that are in the audience today are living through that or have lived through that and knows what's involved in it. And then also, once capacity is in place, partnering with markets is a dynamic relationship. The appetite of a carrier can change, terms and conditions can change, market dynamics can change. So as an MGA and as a distribution entity, you really feel these dynamics very acutely. I think these numbers just kind of bring the point home, and it's almost redundant stating it given what the people in the audience today here do. But I think everybody is aware of kind of the long-term macro secular shifts that are driving the rise in MGAs. Somewhere between 5 to 75% of the premium flowing to the top 100 US P&C carriers is distributed by MGA. So when you think about a carrier in the top 100, so quite a large carrier, 75% of its premium flowing through MGAs, that's an insane distribution channel. I think that speaks to the value and the unique expertise and kind of opportunity that MGAs can get at. But then that really, you know, on the other side of it, really makes MGAs beholden to capacity in order to distribute what is ultimately a financial a product and to facilitate risk transfer.
So if we think about the value proposition of MGAs in the marketplace, they're typically there to bring a certain expertise on the underwriting or the operation side of a certain risk exposure. Typically, that means that they're ultimately writing risks or brokering risks that are niche or hard to cover lines of insurance. And that is ultimately the start of the demise of a program or fronting relationship or an MGA relationship with carriers. There's a limited amount of capacity out there in the marketplace. Not every carrier has the same appetite. If we think about going out to carriers to get an MGA relationship, it's not like there's 15 carriers all throwing out term sheets and LOIs to get on a certain deal. It's typically that it's maybe 3 at most that are interested in a deal, and that makes the options limited. And so once we have a program that's already operating, the demise is very similar. The majority of the capacity is only coming from one, maybe two or three carriers on the primary side. They may change their underwriting appetite. There may be a capital capacity issue inside the carrier. There's two operating businesses over here, the MGA and the carrier, that have their own interests in mind, typically, and so that can change very quickly ultimately. So the first stage is, an MGA is offering a niche, hard to cover line of insurance. You'll have a small amount of carriers that are actually backing this MGA's program. There might be bad market conditions. Underwriting guidelines might change on the MGA side, on the carrier side. And that ultimately may lead to pulling support. It's not an issue that's all too uncommon. Oftentimes, reinsurance brokers and intermediaries will try to keep MGAs in front of a number of carriers and kind of keep them warm in case something does happen, because it happens often enough. Ultimately, that will lead to capacity being lost. The MGA is kind of between a rock and a hard place. They don't know what to do afterwards. That leads to not being able to write business, and then ultimately the business model of the MGA is it requires a restructuring, layoff, scaling down, because they're dependent on capacity on the back end ultimately. So when we think about, well, there's a tremendous amount of third-party risk that these MGAs have now, right? They're not really in control of their business. The carriers are in control of the business. How do we de-risk that? How do we make that a more sustainable solution from stroke of the pen risk, quote unquote, from the third-party carriers? And if we think about the spectrum of risk retention, that's really where we can start developing, a new way forward, right? On the left-hand side, we have a pure MGA, right? They are just a ceding commission, a fee-based business. They're distributing on behalf of a carrier. They're getting commission points. There may be a reinsurance panel behind the carriers, et cetera, but they're pretty much stuck to their ceding commission, whatever they're getting paid in commission from the carrier. On the other side of the spectrum, you have the entirety of the risk retention, right? Where you might have a captive that's, retaining, or a risk vehicle that's retaining 100% of the risk. And there's different ways to structure that. A traditional carrier or reinsurer may be one way of doing that. Offshore vehicles, sidecars, ILS are different ways. Captives are one of them. In the middle is where really we see the value proposition of captives in the MGA space, is where you can retain your core business model of being an MGA. We are a fee-based business. We want to make ceding commission, but at the same time, we strategically want to take risk because we believe in the business. We believe there's underwriting profit on the table here, and you get a best of those both worlds of low risk, right? There's not a tremendous of balance sheet capacity needs as there would be with a full-on carrier, but you do get that upside of potential underwriting profit. That kind of requires us to kind of delve into the fundamental difference between a primary traditional carrier and a captive insurer. As we know, insurance is regulated on a state-by-state level. That's true both traditional carriers and captives. Not every state has statutes that allow for captives. Every state does allow for insurance. They all do have a Department of Financial Services or Department of Insurance. But why would I want to open up a captive as opposed to just becoming a full-on carrier? And the answer is, is really just hurdles and barriers to entry. The licensing process for a carrier can be years. Anecdotally, the workers' compensation carrier, which was admitted in a singular state, it took 6 years for the license to be approved from when we originally applied. That's a long time. As well as there's a tremendous amount of capital needs. You have to capitalize the balance sheet of a carrier, depending on the state and the lines of business you want to write. Each state has different requirements depending on the lines. Each line of business requires a different certificate of authority. It's not like if I'm a property carrier, I can just start writing professional liability or medical, right? I have to get certificates of authority. I have to file. These are long, drawn-out processes that not only themselves, the process costs a tremendous amount of money, but the capital required to write the business also. And there's very strict regulatory oversight, right? So overall, a very, very highly regulated business. Captives, on the other hand, still a regulated business, still do flow through the Department of Insurance in the relative jurisdictions, but there's significantly less oversight. The initial capital requirements for captives are lower. It's not as much of a hurdle. There's more flexible structures. Ultimately, what we say in the captive management industry is that the best thing about captives is their flexibility, and the worst thing about captives is their flexibility. There's so many different ways you can structure the captive, both like statute wise and in how they function. And that gives you ultimate control. It also gives you, a little bit of a tough time kind of figuring out how you want to do it. But that's where we like to get creative and figure that out. Ultimately, there's a big question, right? We have traditional carrier licenses. We have captives. It seems like there's a thin line between the difference. Why would I have a captive? What can a captive do that a captive can't do? Why does regulators allow captives? And ultimately they allow them, and they have statute that supports them because it allows them to align incentives. It allows companies to self-insure, manage risk themselves better. It allows MGAs to take risk in a more capital efficient manner. It allows for more compliance. It supports economic growth. There's taxation. There's service demand. All the typical things of why a regulator would want such a business model in their state. What is the benefit of a captive? And when we think about that, it's not only the ability to take risk, but the benefits that come ancillarily to that. And that's you can control your program better. You're not just a distribution method for a carrier. Rather, you have skin in the game now, and that allows more flexibility, more program control. You're able to have more of a say in stabilized pricing. You can utilize the captive to buffer against any adverse scenarios with capacity, meaning to say if you have a captive that's retaining some sort of risk alongside your fronting carriers, and something adverse happens and they decide to get off the panel, right? While you are figuring out next steps, you can utilize that captive to act as a buffer in that meanwhile, right? In that period in between, to save the business. Big benefit of captives, as with any insurance carrier, insurance entity, is the ability to invest surplus and reserves over time. You're growing a trust of assets ultimately, and it lowers the cost of insurance over the long term. Captives operate typically at lower expense ratios than traditional carriers. So, the blended margin of expense should be lower when you're implementing a captive into the overall program.
So kind of taking a step back for a second, at the lay of the land of captives today, captives are not a new concept. They've been around for decades, since the 50s in their modern form, really. And as unknown as the concept may be, amongst lay people, the proliferation of captives across the Fortune 1000 is actually extraordinarily high. So no less than 90% of the Fortune 1000 have a captive insurance company. That's, extraordinarily high adoption. If you think of any product that you can imagine, imagine 90% of families buying, toaster oven. So 90% of the Fortune 1000 have a captive. They understand the attributes of investing in their risk and then having greater control of it and being able to earn the profit and kind of all of the positive outcomes that yields. Below the Fortune 1000, captive utilization falls off the cliff pretty quickly. That's because captives are difficult to form, difficult to manage. They do require a lot of resources, a lot of expertise. Judah mentioned the incredible complexity and flexibility of the structures. So you need to be equipped with a lot of know-how, a lot of information, a lot of regulatory wherewithal to navigate to the right optimal captive solution and structure and domicile, and then manage it in a really successful way. And we'll get into considerations a little bit later, but captives aren't for everyone. Now, when we talk about captives and the risk that is in captives, It extends to both first-party risk and third-party risk. When we're thinking about 90% of the Fortune 1000 having a captive, that's typically first-party risk. So we're thinking about Amazon or Coca-Cola or Boeing, and they're forming a captive and they're putting tens or hundreds or billions of dollars in there, as opposed to sending that premium to carrier, and they're investing in their risk, and the captive is holding their first-party risk. That's different than an MGA model. When an MGA model as a distribution entity is going to be putting third-party risk into the captive. So that means the MGA or the retail agency or the NG or the distributor of risk is graduating from being a distributor to being a risk owner. We often relate this dynamic from going from renting a home to owning a home. Renting a home, you send rent, or in the insurance case, premium to an outside entity. And with owning, you invest in the equity of that structure, which comes with greater complexity. It also comes with greater upside.
We briefly discussed this before, but there's really two options in how to take risk, or how to how to retain some sort of risk in a vehicle, and that's becoming a carrier or alternative capacity, alternative risk. As it relates to becoming a carrier, there's two ways to go about that, and that is a method and a way that works for certain groups and their mandates and objectives. The first way is you can buy a carrier license, or rather a shell. There are carriers that no longer write business. They have legacy claims on their balance sheet still, and they're looking to sell off the shell. They trade nominally for a price based on where they're domiciled, that is, which state they're domiciled in, and how many other state licenses they have, and the COAs they have in those states. That is one way to circumvent a lot of the time delays. There is still what's called a Form A approval process that still takes time after buying a carrier. The other option is to get a startup license, apply for a license fresh, and depending on the state and the lines, that can take time. It's complex. There are a plethora of businesses out in the insurance services space that make their money by guiding people on both of these routes. It's time consuming, it's expensive, a lot of requirements and seasoning for the operators of such a business, and as mentioned, requires a big balance sheet to get done. The second is alternative capacity, and that comes in two forms. That can come offshore or other alternative capacity mechanisms. There's ILS, there's sidecars. There's a whole industry of capital market solutions in insurance, but they typically aren't geared towards MGAs and their business model. They're just fundamentally different in how they retain risk. Option two, which is what we specialize in, have an expertise in, is captives, and captives are much faster than the traditional carrier, significantly less resource intensive. They're flexible in structures. You can set yourself up to take risk in a plethora of ways, on the primary side, on the reinsurance side, and with different reinsurance structures, both proportionate and non-proportionate.
Okay, so we're going to start getting into what does it mean to get a captive up and running, and what are things you need to consider, and what are some of the potential pitfalls. It's not for everyone, but for MGAs that have the right characteristics and the right kind of attributes in place, it is the way to graduate from renting to owning. It is the way to vertically integrate and kind of evolve to the next chapter and ultimately more profitable span of your life cycle as an entity. So some kind of considerations, and then we'll get more into these. You're going to be putting capital at risk, and that's kind of the heart and soul, the essence of what forming a captive is. And then, of course, as we all know, commensurate with risk is profit, is upside. So that's really going to shine a light on your risk performance. If you're barely skating by with a barely profitable, or not to mention an unprofitable loss ratio as a distributor of a coverage or insurance product, taking risk isn't necessarily the right course of action. We wouldn't advise it. There's going to be admin fees and management costs to consider, just like owning a home. There are responsibilities that come to being a homeowner. And then, kind of potential losses and increased volatility to consider with this graduation and increased sophistication of your business model. Finally, and this piece is really important. We sit down with folks all the time that are thinking about whether they're retail agencies or brokerage firms or MGAs or maybe a SaaS platform that wants to have an embedded program. We really urge our clients to think about forming a captive and taking a risk at least on a 5-year time horizon. And if you're thinking about, what it's going to do and the upside in year 1 and 2 and 3, those are very positive attributes that are going to be complementary to your business model. It's going to allow greater flexibility, crafting greater kind of experiential design, maybe the ability to leverage your technology to greater effect. But in terms of really reaping the fruits of your labor, just like investing in a home or any other sophisticated financial structure, we need to be thinking about the long term. There's kind of a lot of things here to cover on this one. If there's one piece that folks should take away, captives allow for incentive alignment. And going back to the macro trends that are driving kind of the rising tide in MGAs and new forms of risk distribution and insurance products meeting the market, if capacity or carriers, markets are looking for one thing that is a real differentiator with the MGAs that they partner with, it's going to be that incentive alignment. So, you're going to hear the term a million times, skin in the game. And the captive is the greatest kind of way to put something together where you have skin in the game, and that's going to yield a positive kind of feedback loop with your markets, with capacity, and kind of configure all the pieces in the right way. And then at a very high level, and of course, as you can imagine, this warrants a deeper conversation. So, we are happy to follow up and take anyone that's interested into kind of a deeper dive into the actual mechanics of the process. Setting up a captive is first kind of understanding the business case for it, the performance of your risk, the success and viability of your distribution model, the ability to fund a captive. And funding a captive can come about in a number of ways: your own balance sheet, external balance sheets, how you split the risk, and slice and dice the premium and the capacity with markets and external partners. So kind of crafting a clear, coherent vision, making sure that it's viable, and then a very, very involved design process. And that's where we really get into the legal mechanics, domicile selection, tax consideration, bringing reinsurance and fronting structures to bear, setting up claims programs. Often for an MGA, you've got a lot of these pieces in place, right? So an MGA may already have a really well-running claims apparatus that can then be optimized with a captive, and you don't necessarily need to reconfigure everything. Executing on that strategy, forming the captive, which when we boil that down to its most simple element, forming a captive means setting up a bank account and getting licensure and approval from a regulator. So that is kind of the moment of truth. And everything that goes into and around a captive operationally and really setting up this business unit, it boils down to opening and operationalizing a bank account, which is going to serve as your risk-bearing entity, and having the proper regulatory and legal credentialing, and then ongoing management of the captive, which is a sport in and of itself, kind of.
This is depicting an example structure that's relatively common in the distributor or MGA space. So that's, typically what we would call an agency captive. And, an agency captive is something that is allowed in certain states, captive statutes. And if you think about it illustratively, you're writing business as the face of the program, right? So when an insured buys a policy from MGA ABC, right, they think that MGA ABC is the one that's, they're both distributing and potentially taking risk. If we look where the risk flows, the risk is flowing from the captive or the captive cell, which the MGA may own. That'll take, in this example, 40% of the risk retention here. 60% of it is going to the fronting carrier, and this is very oversimplified. Technically, it's the other way around. The fronting of the MGA, the captive is rather really reinsuring the fronting carrier, but it's all for illustrations purposes. The capital is to the fronting carrier, and then there's reinsurance backing up it all, right? And so if we think about how premium payments come and claim payments come, the MGA is still at the forefront of the business. It's really just behind the scenes. Where is capital going? Who's taking risk? And the captive is really alongside the front, and then the reinsurer backing it both up, as there would be in a traditional program. Within the captive itself, and kind of how expenses and costs are allocated, there's a number of different ways or directions the captive premium actually flows, right? So as we mentioned in our example, 40% of the premium is being retained by the captive. The other 60% is being retained by the fronting carrier. Within that, 37% in our example are going towards expenses, and those expenses can be reinsurance costs for the captive's reinsurance, or the captive's pro rata share of reinsurance together with the fronting carrier, captive management, any fronting fees that are being charged by fronting carriers, taxes, boards, bureaus, any claims and TPA fees. And then the remaining 63% of that is going to go to what we call the loss fund. And the loss fund is, the same as it would be at the carrier level. Is 63 cents on the dollar of premium are retained to pay out claims. If our expected or actual losses and reserves are 50%, that leaves us with a surplus in the captive of 13%. And obviously there's development and case-based reserves, and then all that stuff. But on a basic level, right, you have expenses, you have loss fund, and that's how it's really structured from a premium flow standpoint.
Can I, Judah, just to kind of interject here, this kind of helps shine a light on what is often a test for MGAs when they're thinking about whether it's time for them to form a captive or not. And it can play out, in a pretty kind of simple numerical fashion like this. I am an MGA. I am right now ceding all of the premium that I earn, that I distribute from the product I sell, and I'm ceding all of that premium to a carrier or a reinsurer or a panel. And in return for distributing that product, I'm getting 20%, 25%, 30% commission back. If I form a captive based on a certain loss ratio and the success of my program and what it would take to set up a captive, can I make more money than that in terms of owning the profit by forming a captive and taking on some of the risk, some or all of that risk? So that when we look at the numbers here, this ultimately kind of leads to the test of viability for MGAs and risk distributors thinking about captive solutions.
And we just received a question: is the captive acting like a reinsurer? And the answer is, it depends. In this situation, technically, yes. A fronting arrangement is one in which the captive is technically a reinsurer. So the premium flows technically through the fronting carrier and then out to the captive in the back, depending on how much premium is or isn't being retained by the fronting carrier. But the captive is really the reinsurer. There will be a reinsurance agreement between the fronting carrier and the captive. In certain other situations where there may not be a front, the captive can take a primary layer of risk. It could take a reinsurance layer of risk. Those are, the flexible structures that we discuss. And there's, a few just, use cases just anecdotally in the MGA space in specific, right? Because captives are very well established, as Gabe mentioned, in the self-insurance arena. Large corporations, companies, upper middle market that are going to retain their own risk, but using more use cases for MGAs, which is a newer use case for captives. It's just a few clients that come up to mind. There's a group that's offering rent guarantee or indemnity, essentially where they're plugged into landlords, in a certain area. Those landlords want to offer a guarantee program of rent, right? So if a tenant misses rent, they want to be compensated for that missed rent. So this program is receiving a commission currently. They're acting essentially just as a broker, and they're utilizing a captive to retain some of that risk. It's been operating very well so far as a broker, as an exclusive broker on the program. They see the loss performance and they want to take a share in that risk to be able to make some underwriting profit. I'll let Gabe, discuss client number 2.
Yeah, so there's an entity that is distributing a cyber security solution, MDR, managed detection and response, doing a great job. And as a result, the customers of the client have really, really, really low cyber losses. So client kind of wakes up one morning and says, wow, I should be distributing an insurance product around this. And not only do I want to sell the cake, I want to bake it too. And so they're forming a captive in support of being a distribution MGA for that cyber solution. Really quickly here, just a couple of final points, and we do have some pretty good questions coming across that we want to get into before we run out of time. This is a very high level look. Obviously, for anybody thinking about a captive, wanting to learn more, we love talking about this nerdy stuff all day, every day. Can't get enough out of it. So please reach out, and we'll be happy to have an in-depth conversation and take a look under the hood at your situation. Also, for anybody that will be at a little place called InsurTech Connect in Las Vegas next week, we'll be there, and of course happy to meet up if that fits. But just kind of to tease the point and to get you thinking about it, here's a very high level checklist. Have you got 600,000? Kind of edging towards $1 million of premium flowing through your distribution model, through your MGA, through your agency, however you're distributing risk. Do you have some measure of capital on your balance sheet that you could use, even if it's a minimal amount, to fund a captive, to get it up and running, to kind of put fuel in this gas tank to get the engine going? Do you have a favorable loss ratio? Do you think you can be improving upon the commission that you're currently earning? And then the last one, I mean, obviously everybody wants to customize the product you're distributing. Everybody wants to have a really optimal experience that you're delivering to your clients and customers around it. But just, is there the opportunity to take it to the next level? So that's kind of a preliminary checklist, but happy to talk more in depth. And then, a couple things to kind of take away here, and then we'll open it up to questions. Just, in thinking about if the time is right for a captive, and then what is required to have a successfully operating captive oriented towards those long-term outcomes that we discussed. Data driven, and for the MGA crowd, I presume that's pretty old hat and kind of baked into the fundamentals of what you do. Number 2 there, it says a new mindset. So this is graduating from thinking like a distribution and sales entity to thinking like a risk-bearing entity, and that is something that takes real consideration and kind of the next level of discipline as an entity and as a leadership team. We often encourage our clients to start small. You don't need to take on all of the risk all at once. You don't need to reconfigure your claims apparatus or kind of reinvent the wheel. You can begin very incrementally. You can start with simple structures, get things up and running. You want to start smart. You want to have an ability to demonstrate a winning strategy that's going to matter when it comes time to also provision reinsurance or fronting for your captive, time for regulatory approval. And financial hygiene, can't say this enough. If you're thinking about a captive, now, in a year, in 5 years. Financial hygiene is going to matter, and everything's going to see the light of day. So may as well get ahead of it. With that, we'd love to get into some of the questions that have started to come across. Judah, if you want to jump in, or I'm happy to.
Yeah, for sure. So we received one question. With the Fed interest rate reductions, do you think that VCs and reinsurers will be open to working with MGAs like we saw in 2017 through 2019? Or will MGAs need to start working with more captive arrangements that take risk in order to attract MGAs and VCs? The answer, is really the latter, right? There's two considerations on behalf of capacity providers, whether that be fronting carriers or reinsurers, when working with an MGA. Obviously, cost of capital, so Fed interest rates, of course, do have a direct impact on that. But additionally, really is performance of risk and the overall insurance market from a risk standpoint. We're undoubtedly in a pretty interesting insurance market right now. Property's hard. U.S. casualty is set to increase by another double digits at 2021 renewals in 2025, according to S&P or Fitch. I forget now. Right, so we're definitely in a hard market across a number of lines, where reinsurers and capacity providers are starting to question the risks they take with MGAs. Right, there's a fundamental disalignment of incentives with MGAs. MGAs are brokers ultimately, right? They might be exclusive brokers, they might have a certain underwriting expertise, and they do want their book to perform, hopefully, right? But ultimately, they are not incentivized in the performance of risk. Rather, they're incentivized in premium value to just make as much commission as possible. That's at a basic level. There may be sliding scale commission or profit share on upside, in more complex structures, or where MGAs are willing to risk cash flow. But in the standard, ceding commission level, arrangement, they're disincentivized, and reinsurers and fronting carriers have been and continue to look for alignment of incentives with MGAs, them taking some sort of layer of risk, varying from 15, 20% up to 40% typically, depending on the nature of the program and whatnot. So that is being mandated. We see that a lot of groups coming to us, not necessarily at a desire. Ultimately, at some point, there is a desire because they see the upside in a captive, but because it's being initially mandated by capacity.
The one further piece on that, just on the general topic of VCs, whether they're a standard kind of tech-oriented VCs, or whether they're VC arms of reinsurers or insurance carriers, they're going to look really favorable on captives if it's put together in the right way. And, if there's a strong premise for it, if the risk is well performing and there's sound actuarial modeling, and this is, not to kind of give the sell here, but this is what we, of course, are here to help our clients with. But there is a pretty stellar laundry list of MGAs that have graduated to taking on risk, to having a captive, and to having really home run capital raises partially as a result of that. So that's a well-trodden path.
We received a few more questions. So it looked like there was a follow-on question for the previous question about retention and MGAs and reinsurers. I see more and more reinsurers are requiring MGAs to retain what MGA has underwritten. Do you believe fronting carrier can play that role on behalf of the MGA, or reinsurers want MGAs, not fronting carriers, to retain the risk? Yeah, it's typically they want to see the MGA retaining the risk, because ultimately the fronting carrier does have skin in the game. Even if they're a pure front, they're not participating in any risk capacity. They still ultimately are taking hits on ceded reinsurance, and there's collateral requirements and whatnot that could end up burning them. So they do want to see the MGA actually taking risk themselves oftentimes, and not just the fronting carrier. How much experience should you have on a book before being willing to take the risk in a long tail line like GL? It varies. GL's, it is a longer tail. It's not the longest of tails for sure. We see groups that are really, really fundamentally startup programs, not only just the fact that they're starting a new program, but the actual concept of the program is a different line of insurance and non-traditional as it gets. So, you know, we see groups with no experience, and we see groups with a tremendous amount of experience. It's always easier when there's experience, and it's always significantly easier when there's a book to roll over. Fronting carriers, reinsurance want to see that premiums coming in, you know, in the first year on day one. And so if you can roll over a book, or if you can have premium coming in the door in the beginning, it definitely helps those conversations with reinsurance and fronting. How much
David,
capital?
are
Please.
are we at time, or do we have time for one more?
We can keep going for a couple more.
Okay. Cool.
Okay. Gabe, I don't know if you want to take any of these.
I was really enjoying you just kind of going through them.
Okay. I guess I'll strain my voice a little more for you.
Sure. Thanks.
How much capital do you need? What's good rule of thumb in terms of capital needed for $1 of premium? It's unfortunately too vague, and as I'm sure you all know, being in the insurance industry, as the answer always is in insurance, it depends. Depends on the line, depends on the state, depends on a lot of things, and so can't really say at a base level from a minimum statutory capital perspective. It'll depend on the structure of the captive in the state. For the line, typically you start at a base of 3-to-1, meaning for every dollar in premium, 33% of it has to be posted in capital and surplus in the balance sheet beforehand. Premium can satisfy that depending on the situation, but then it could go up to 7-to-1, et cetera, et cetera. So it really does depend.
Jude, I'm happy to jump in here for the last
Yeah, please.
couple. Yeah. So so for our fees, the way we monetize our business as a captive manager is when, you know, at one of the slides that Judah went over, he showed kind of the expense breakdown of a captive. I think it was 30-something%, you know, roughly 1/3 plus of the capital in the captive going towards expenses. That's pretty standard. We're always going to fit our fee within that, right? So you should think about our monetization model as a component of the operational fees to manage the captive. You know, just like a business unit has OpEx to keep the wheels running. So we work with our clients to partner with them to align our incentives together and to manage our fees to fit nicely within the expense profile of that captive, and to not, of course, undermine the profitability of the captive. That's what we really care about on our clients' behalf. We incentivize align our incentives towards that. Are there funds that specialize in contributing this type of capital needed to fund captives, and how much is the return expectation for this type of capital? Yes, there are. There's, you know, captives are still quite niche, but that being said, they're kind of established enough that there are capital and financing players that have emerged to satisfy a demand for financing in this space. Jude, I don't know if you feel correctly. I'd kind of offer, you know, think about it in terms of normal financial structures, in terms of normal debt structures for financing an investment vehicle. I think if you think about that, you probably wouldn't be too far afield from what you should keep in mind.
Yeah, it's not the most robust ecosystem of capital market solutions, but there are providers that have a number of ways of helping either fund collateral or balance sheet capital. And, you know, that's definitely something that we help provide and service as a part of our one-stop shop solution for the captives and MGAs that we provide services for.
In the final minutes here, I know we're already a little over time. I'll pivot from doing a soft sell to just doing a good old-fashioned hard sell. We take pride in being an absolutely comprehensive one-stop shop for our clients. The reason we went into business is because we think captives are a fantastic structure. It's a fascinating vehicle, and it should be in the hands of many, many, many more entities. We looked around the ecosystem and found real dissatisfaction amongst companies below the Fortune 1000 with how captives are delivered to them. And we wanted to improve upon that by making a more comprehensive end-to-end kind of, you know, single throat to choke, really seamless experience for our clients, basically reconfiguring and retooling this great structure and all the opportunity that comes with it for a way that is really palatable and enjoyable for the clients that we serve, which, as we discussed, extends to many MGAs. So if folks are interested in learning more, taking a look under the hood and having a frank look at if the time is right for them, we'll be very happy to connect. And we are usually very happy to tell people we're connecting with, yes, the time is right. No, it's not. Here's what you need to consider, and to start that dialogue. But on behalf of the XN team, thank you very much for everybody being here today. And on behalf of InsurTech New York, thank you so much for having us.
Thanks, Gabe. Thanks, Judah. Hopefully those that participated learned a lot and got some insights on how you can de-risk your MGA model. I would say just maybe one bona fide for the XN team is that we have selected them as our official partner. So they are our captive manager. And there was a question earlier about, alternative financing or risk share. So, we are setting up a structure to participate alongside some of our partners, whether it's those have gone through the MGA lab or some of our portfolio companies for the fund. So all of that is only possible because of the XN team.
Thank you. Appreciate everyone's time.